Hi traders, this is Thiago and welcome to Bull or Bear Futures channel. If you're not a subscriber, please subscribe to the channel and leave your like in the video. Today I'm going to talk about a really important subject, that is the interest rate. In latest days and weeks, or actually we are always talking about the interest rate cycle. In the case of the US, what Federal Reserve is going to make, or how the monetary policy will work. This is actually what we are living in recent times. These projections or these doubts about what could be coming next. Okay, so regarding the interest rate, the first thing that is important to know is that market works always with projections, with forecasts. So regardless what actually happens, or what Fed actually decides, what moves market most of the time is what markets think that Fed is going to do. All the work of researchers and economists is to try to anticipate market moves. This is the way to make money. The first movers are detecting the trend, detecting a trend. The first movers make more money. So I'm trying to make a huge simplification in a really complex subject. Not going to approach economical concepts or premises regarding the issue. I want just to show you a simple formula that's actually really complex behind it, but just to give you an idea, a rough idea about the impact, what happens when it, or why prices move in such a direction when interest rate rise, and usually in the other direction when interest rate goes down. Okay, to do so I will need to show you this formula, that is the net present value or the discounted cash flow. This is used by the market to make companies valuation, to try to find the fair value of an asset and compare it with the market price or the current price and see whether it's expensive or it's cheap. Okay, so this formula shows you that in the numerator we have the net cash flow. Okay, that means the money inflows minus the money outflows. And in the denominator, we have the interest rate or the cost of capital. This is to give the money the value of time. Okay, we take this formula takes a cash flow that will come in months or years and divided by this term here that involves the interest rate, it makes what we call the present value. It considers the current value of that cash flow. Okay, so consider we have the interest rate here in the denominator. What happens if we see a rise in the interest rate? The denominator increase, and if denominator increase, what happens with the result? Result, that's the net present value or discounted cash flow, reduce. Okay, so very basically speaking, simplifying hugely the subject, if we see an increase in the interest rate, we see a reduction in the valuation or in the value of the asset. When the opposite occurs, that means when we have a reduction in interest rates, the result of this calculation leads to an increase in the result, then an increase in the value of this cash flow or this company. Okay, so when we are talking about long cycles of reduction in the interest rate, we are seeing the interest rate reduce its pressure under asset prices so as it can lead to an increase, or when we have this perspective of reduction in interest rate, the value tends to increase, and so the stock exchange move upwards. The opposite is true. If we see, such as we've seen recently, a cycle of increase in the interest rate, or we see the monetary policy getting tight, we see a reduction. We tend to see a reduction, no, considering all the other variables constant. This generates a reduction in the company's valuation and tend to make market moving downwards. Okay, so basically this is the impact. Trying to make things simple, interest rate is in the denominator. So this is basically why when it increases, we tend to see valuation get depressed, and when it decreases, we tend to see increase in valuations, and then stock exchange moving upwards. Okay, this is what I intended to tell you today. Hope you have enjoyed. Any doubts, just drop me a comment. I will be glad to answer your question.